context webinar for the fourth quarter 2015 for clients of the advisory group and WealthStep. WealthStep is a division of the advisory group that provides a simplified service for up-and-comer clients. My name is Greg Patterson, and these webinars are designed to provide high-level perspective regarding the economy, markets, investor behavior patterns, and other helpful information in order to help both our personal wealth and institutional clients better achieve their goals. We try to keep these meetings to 20 minutes. The fourth quarter meeting is sometimes a few minutes longer because of yearly asset allocation research updates that we provide, and then we will circulate a video link afterwards should you like to view some part of it again or pass it on to someone that you think might find it helpful, and particular people that you think we can help like we've helped you. If you have any questions, please submit them to the question box and we'll try to address them either as we go through or at the end of the presentation. So high-level goals are obviously critical, and we always encourage clients to focus on the critical segment of the area between where things matter and what you can control. As you think about how your goals evolve in terms of what you require versus what you desire in the short term and the long term, we want to have that conversation with you to help you build a plan and build your financial bridge towards the outcomes that you are seeking. If we take a look at the market overview, while the first quarter has been fairly bumpy, the fourth quarter was fairly solid. In general, equity returns were strong, bonds a little bit negative. And for the year, however, given some bumps along the way during the prior four quarters, some mostly negative returns across equities, and with the exception of bonds where some volatility over the course of the year created some concern in equities and pushed the yield down a little bit, which pushed prices up over the course of the year just a hair. If we look at volatility patterns, you see currently the VIX index and the Dow Jones Volatility Index are at the level shown here by this dotted line, which is approximates higher volatility periods in recent history, and going farther back doesn't have periods that are similar unless you go back to 1975 or going back actually to periods surrounding the Great Depression. So in the last 15 or 20 years, higher volatility has become a little bit of the norm. We'll talk about a little more about that as we go along. The Fed raised rates for the first time in 9 years by 25 basis points or 0.25%, moving rates up from 0% after 7 years. And the Fed targets of about 5% employment are right around where those numbers are. However, the Fed hasn't been entirely satisfied with that, and there's a 2% inflation goal, both of which are relatively soft targets. They want to make sure that the economy is on strong footing before raising rates in general. However, today some sort of mixed signals from the Fed came out suggesting that they might still raise rates in March, but we'll see where that goes. Oil has been an interesting part of the overall story, as has China, in terms of more recent stock volatility, particularly in the first quarter, with oil dropping as low as $26. More recently, it's up in the low 30s, but this is quite a departure from the 2008 price of $148 a barrel, or the end of 13 at $98, or even the end of 14 at $53. There are a number of factors surrounding that, including supply and demand, heavily affected by the Saudis injecting excess supply in part in their attempt to harm other oil-producing countries and companies. And some would say that that's not sustainable even for Saudi Arabia. They need and want, at least for a social unrest avoidance standpoint, to have oil, some would say again, closer to the $50 to $60 barrel excuse me, range at a minimum. So that's been a challenge for energy markets, unlikely to remain at those lows for too long. However, it's hard to say given the the continued concerns about global weak overall global growth. Speaking of growth, the U.S. was at a solid but not exciting 2%, whereas the 1.6 of Europe and Japan is considered to be slow growth, and China at 6.9%, much higher than the developed world, but that's a drop from higher growth rates, which is part of what's caused concern in the equity markets. Notable as well that inflation remained about 2% for what's called core inflation, but if you include energy and food, actual inflation has been closer to 0.4% for what's called headline inflation. So depending on which measure you look at, inflation is right around the Fed target or lower, and so the Fed overall looks at that as being under their 2% target. Pardon me. If we look at economic indicators, unemployment again has improved. Wage growth has only picked up a little bit, however. That's going to be an important component for driving overall economic speed of growth. The labor force participation rate is down. That affects the unemployment number calculation. So this drop in unemployment may not be quite as strong as it appears if fewer people are seeking jobs. Inflation remains relatively tame. Here you can see the numbers we just talked about, around 2% and that 0.4%. So a little bit lower than what the Fed would like to see. Consumer sentiment has been wavering around a healthy level, although that's a bit of a tenuous number. And the federal budget deficit continues to be sizable, currently at about 4% of GDP, and this is one measure of the pressure on the overall system as a backstory for the overall economy. This is our yearly update of historical equity markets, U.S. markets, a histogram showing 227 years. We can see the 2008 return of negative 37. That was the only negative return in the last 8 or so years. The memory of many people seems to perceive that they were more negative years than they actually were. And so the 2015 return of 1.4%, while positive, is weak, but not nearly what some people have rapidly become accustomed to of high returns after the bottom of the global financial crisis. 5-year averages about 13%. 10-year average around 7.3%, not too far off the long-term capital market expectations, the 10-year projection. And if we look over the 227 years, 6% of the time returns fell in the 8 to 12% range. So very rarely do actual returns fall near the projected returns, but the averages do end up falling in that projected range. And about a third of the time, returns fell under 4%. So it's normal to have both weak returns, positive returns, and negative returns. As you can see here, as divided by this dotted line, the distribution is positively skewed, with about 3/4 of distributions roughly being positive over the years. But look at very long-term history, just focusing on U.S. equity markets for the moment. Last 30 years, returns have been around the 10% mark, 20 years around 8%, 10 years around 7%, 5 years, which cuts out or excludes the global financial crisis, but includes the recoveries at about 12. The last 3 years also excludes the global financial crisis around 15, and more recently, a little bit of pullback, given really how strong these recent markets have been, and markets getting a little bit ahead of themselves. Also notable to look at inflation over time. Of course, these longer numbers are pulled down, as they are in other cases here, by weaker recent numbers, but long-term inflation about 30 years, or about 2.6 for 30 years, whereas going back to 1950, it's about 3.9%. If we look at markets cumulatively since around the 1950s, there are two different ways to look at them. The more common method in terms of return calculation, or the way charts are shown, is a standard cumulative chart. This tends to exaggerate visually the effect of more recent returns because of that cumulative effect, whereas a logarithmic scale shows the peaks and valleys more proportionally, so that what you are seeing is in any given year is more proportionally relevant or comparable to other periods in the past. So for example, on a cumulative scale, if you have a large increase, that's building on the cumulative returns of the past, which magnifies this, whereas the logarithmic scale really shows, in many ways, a more accurate story of what the experience was at any given point in time, whereas on the normal scale, there's some significant peaks and valleys going back decades are essentially compressed in the normal cumulative scale. So that can help put some of the perspective, the markets in perspective, that what we're seeing now and over the last number of years is, while significant, is less dramatic than it might appear compared to history. Speaking of more recent history, or the four bad bears, the four worst U.S. markets, as an update here, the current recovery market is in blue, and the financial crisis beginning that line here. The gray is the Great Depression in recovery. The green line is the dot-com crash in recovery, and the red line is the oil and financial crisis of the 70s and subsequent recovery. And this black line is what we called our squiggly square root-shaped recovery, which we drew in 2009 to estimate what a normal pattern would be of a market recovery, usually a V-shaped, initial V-shaped, followed by more normal and gradual recovery, but an initial bounce back. Turns out the actual market had that shape actually faster at the beginning, and then much stronger returns for the last couple of years, in part due to the low or cheap money Fed policy. So if we take the recent cooling and draw a line straight over to the projected stock market return, that would suggest that there is some of this course correction is happening, would put us, if it just went sideways from here, in about 300 days, or about 1.5 years of market days, we would have had some reversion to the mean to get back to quote-unquote normal. So the markets do tend to revert to the mean over time, not always comfortable, but if you look at the current volatility in that light, it's not necessarily an indication of the world falling apart. It may just be part of getting back to more normal returns if the current market has overshot a little bit. As a reminder, it is difficult, if not impossible, to diversify away overall equity market risk. You can reduce it through diversification, but it's hard to eliminate it altogether, or impossible. And as a result, it really is necessary for those who have future goals that depend on growth to take on some level of volatility. So being prepared for that is part of being an effective long-term investor. If we look at required recovery returns, you can see market numbers have cooled off a little bit on the cumulative basis, although the fourth quarter was a little bit strong, so it's pushed numbers back up back up over 300%, whereas the prior quarter and currently these numbers are below. These are based on the cumulative returns from the bottom of the market in 2009. International equity still has a ways to go, about 7% per year to catch up, to get back to its top. That is the recovery is taking longer there, and partly influenced by the dollar. And if we look, however, that number has shrunk over time, as not too far back, it was a higher required return to get back to the top. And this little napkin chart that we've had on this page for a while has really been focused on, well, how long will it take to get back to the top? And looks like that top might have happened, at least for now. And if we look at our squiggly square shaped market, we see this UR here is sort of somewhere on this chart is, we're past or at somewhere around the peak. It's cooled off a little bit since then, and this gray or dotted line over here in the same color represents roughly where we might be now. This gray line represents the original squiggly square root economy shaped market recovery that we drew a number of years back. And what seems to have actually happened instead is not dramatically different, but materially different in that it had a faster recovery than expected, a little bit with what many would consider an overshoot relative to a normal market recovery. And where we are now is somewhere in the process of bringing things back a little more to normal, the long-term averages, as we mentioned. So depending on the timing and how that happens, really what we're seeing is likely just a reconnection of normal, what would have been a normal market recovery, and a little bit of an overshooting of the actual market recovery. So in terms of market dynamics, what is helping contribute to that? Talked about already about the uncertainty after a long bull market, low rates. We'll talk about high PEs in a moment. Profits of corporations in the U.S. remain near all-time highs, and some question about how sustainable that is. Consumer spending has been solid but not strong. Wage growth we talked about. So a number of factors there. Oil, we already mentioned, has, well, some would say would normally stimulate the economy because it decreases production costs and consumer and gas pump costs, creating a tax credit, really. But consumers aren't spending all of that. Some of they're saving and are still concerned about the economy. China is another big factor. However, there's some interesting elements that some people may be overlooking in the general investing public, and that is that part of what's happening in China is they're gradually becoming more developed. So having a 7, 8, 9% growth rate is not infinitely sustainable, and as they get more developed, their growth rate, it's natural that would slow down a little bit. Markets may not like it, and that has implications about oil consumption and purchasing and broad consumption and manufacturing and so forth. But that's part of what's happening. The Chinese government has also had an off and on approach to supporting the equity market. They were pretty active in manipulating that market, really, and were pretty heavy in the last number of years in terms of pushing the average investor into the market and selling the idea fairly optimistically. So now that people have more Chinese citizens have been in the market, now that things are getting a little bumpy and the Chinese government has been maybe made a few mistakes and a little bit shaky with their attempts to manipulate or support the market, making people nervous there. And 81% of all tradable shares in China are retail, Chinese retail investors, versus about 55%. No, rather, even though that's only 11% of overall households in China versus 55% of households in the U.S. that own stock in the U.S., for example. So the patterns are different. But with that, in that hiccup, it's normal that there are many first-time investors who were sold by the government the idea of easy, strong, persistent growth markets, and that's not happening, and that can create some sell-offs in shares there. So with all of that, in terms of the context of the equity markets, I want to say, well, you know, what's the alternative? Is it bonds? And bonds aren't, you know, too exciting, particularly with low rates and rising rates, which may cause some additional volatility there. So this is not a pessimistic message. It just means that it's going to take more effort to get the same level of return and more discipline and patience for the average investor in this type of environment. We are not convinced there's a big bubble, but the idea that there may be little isolated bubbles here and there could yield some surprises down the road. We'll have to see how that plays out. One example of that is that Uber recently had a private valuation of about $62 billion. That, in the context of them likely losing money at this stage, not being profitable, and if you compare that valuation, that's larger than 21st Century Fox, Ford, Time Warner, GM, Netflix, PayPal, eBay, and so forth. And companies like eBay, Time Warner, and Ford have $18 billion, $23 billion, and $136 billion in revenues, whereas Uber has about $2 billion and is losing money. However, venture capital investors like the high growth rate, and so that's part of what's commanding that valuation currently. We'll see if they go public or when they go public, how the market responds, and that may depend on naturally what happens between now and then. Another interesting element in terms of if we look at the S&P 500 and the different segments, the top 10 performers for 2015 were up 53%. The rest of the index, the average return was negative 4%. So the top 10 really had a big influence on that return, and it's not like the overall market was positive. And so if you remove those numbers, the overall index would have had a bigger negative for 2015. There's a term called the FANGs that some people are referring to that are included in this top 10, Facebook, Amazon, Netflix, Google, that have really been driving some of those oversized returns in the short run. So just something to be aware of. There's a little volatility that may be down the road with some shakeup of some of those companies that could cause volatility to pick up a little bit. But it may be some of the non-top 10 now that have greater strength and sustainability over time that would help offset those weaker returns if some of those high flyers cool off a little bit. If we look at valuations, what the numbers show after the end of the fourth quarter, these numbers will switch a little bit likely after the third quarter if things persist, and a little bit of cooling, is that the average, the current is a little bit above the historical average in terms of price earnings, which is a measurement of company valuation to get a sense about whether something is relatively fairly valued, undervalued, or overvalued. So it gives you some sense. Emerging markets are maybe some of the more attractive valuations currently. So some of the stocks that investors are most nervous about may be the best opportunities in the diversification set that will potentially provide more reward over time, although there may be a little bit of shaking out to do there still. There's another measurement of PEs, and that's what's called the Shiller PE, which adjusts earnings for inflation. Some say that this tends to overstate things and that generally would never say that markets are undervalued, so you have to take this with a grain of salt. But if you look on a relative basis, it would suggest that relative to historical Shiller comparisons, that valuations are a little more rich than the average. That's not entirely predictive of anything in particular, but generally when PEs are floating up into their higher ranges, the following 5 years are weaker than the long-term averages. We'll talk about some of the long-term averages a little later. If we look at bonds, it's positive for the year, but weak, around 0.5%, with volatility of rates going, the increase in the Fed's rate, but more importantly, the general market-driven price changes as investors' concern increased or decreased over time. This is also the time of year we update the periodic table of returns. It's maybe difficult to see the details of the white text here, but the high-level message is that this is each column is a year, and each color is a different asset class. And it's clear, just from taking a quick glance at this, that there is no obvious pattern of returns over time. So there's no crystal ball, and the key then to make sure that you capture the top performing asset classes every year is to be highly diversified. That also helps ensure that you don't have overexposure to the weakest performing asset classes in any given year. So one of the most valuable illustrations of the importance of diversification that we've encountered. The black box that floats somewhere around the middle is a globally diversified stock bond mix of 60% stocks, 40% bonds. And that tends to float through the middle lower range. Part of the reason it floats to the middle lower is there's just simply more stock indices on this chart than there are bond indexes. So that's part of why that's visually appears that way. If we look at investor behavior patterns generally persisting. Interesting to note, in general, people buying towards the peak of markets and selling at the bottom of the market and moving money around, the average investor, mutual fund industry flows. And most recently, 2015, a big chunk of money, $140 billion, went out of U.S. equities and went elsewhere. You can see that it's not totally additive here because some people take money out altogether or might shift into a different asset class. But in general, is not a pattern you want to follow. And you can see down here, a different way to illustrate that is the S&P 500 return is the line, and the bar charts are net outflows or net flows. In this case, net outflows. As things start to cool off, people start pulling money out. Of course, that drives prices further down, and is generally the opposite of the, a strategic, long-term strategic approach that promotes better economic outcomes. A chart we pull out every few years and update is the chart here that shows that in all years there are negative returns within a year, and in most years, even the very positive years, there are sometimes significant stock market drops within the year, later followed by a recovery. So for example, this year here recently, a 30% return had a 6% drop. Here we said 23% return had a 28% drop during the year. 34% had a 3% drop during the year. So it's common. We're not making any specific predictions about how 2016 will turn out, but it is very common to have negative and sometimes significant negative periods during a given year. Also below, we can see that the years, any given year may have quite a number of 5% pullbacks in the market. So for example, in 1946 had 11, 74 had 17, 2008 had 24, and the positive years more recently had 5, 10, 2, 1, 2, and 3. So very normal to have some negative sequences within any given year. Another way to, a valuable view on market volatility is that the longer you hang on, the less your risk is. So the top chart shows the amount of time in gray that markets were negative for the growth of $1 or $100 in this case, versus when markets, or that dollar of an initial investment was positive. So if you look at 1 year views, markets are positive more often than negative, but there are quite a number of negative periods. If you look at 5 years, there's only a few negative periods, and even fewer when you go out to 10 years. And of course, if you go to 15 or 20, that number shrinks essentially to all blue. If we look at quality, the quality thermometer, this is one snapshot of how high versus low quality, or another way to think about it is more conservative to more aggressive stocks have done over a certain period. So for the quarter, higher quality outperformed in the fourth quarter. So far, this is a lot more green for the first quarter, where volatility, higher volatility markets, higher quality stocks tend to do better. For the year, which we had more volatility overall versus the fourth quarter, there was quality had a bias, a benefit. Higher quality stocks tended to outperform materially, and the numbers that you see here are the annual return of outperformance of quality relative to low quality. In this case, where large cap growth, quality underperformed by 4.1%. Over here on the right, we also show just the patterns of quality and high quality and low quality taking turns performing and outperforming, and we try to incorporate an element of quality in portfolios to provide a little bit of extra, an element of downside protection for difficult markets. If we look at this quarter's asset class corner, this reflects the yearly capital markets expectations update. This data is hot off the press from Callan, the resource we use for the projections of risk, return, and correlation. And we can see the projected return for equities, for bonds, and then for other asset classes or strategies. And the overall summary is best illustrated here, where in general, partly because of the weak economy and the strong last 5 years, that it's expected that the average equity return will drop a little bit, fairly in tandem by about 0.3% or a third of a percent. In general, bonds stayed the same to being slightly positive with the exception of international fixed income. But in general, some positive numbers here because over a 10-year period with rising rates, that will increase the returns, although there'll be some volatility on the way to get there. Inflation remains at about 2.25% as a projection over a 10-year period. So that reduction in projected return is also consistent with some longer-term patterns. If we look back at the projected returns over time from Callan, 95, 2005, 2015, what it would have taken to get a 7.5% return has changed significantly over the course of the last 10 or 15 years. In 95, you wouldn't have needed any equity at all in the projections to do that. Could have been done essentially with fixed income and cash. 2005 required additional diversification, including asset or equities. And we're not, this isn't adjusted for inflation, so that's some factor here, but inflation has not been particularly high over this overall time period, so not a big factor there. In 2015, further diversification, more equity, down to 12% fixed income for someone or an organization that wants to achieve still a 7.5% return. So the need for discipline and dedicated investing has increased over time, and risk has increased as well. Down here we can see the plotted charts of the Callan's projections over the years from 89 to 2016, and generally equity returns have dropped in terms of the projections, whereas risk has roughly stayed the same and more recently has inched up a little bit. So it's basically just meaning that it's going to take a little more work to achieve the same levels of return and a little bit more patience. That is our conclusion for the quarterly context at this for today, and we look forward to any questions you might have. We always value your input in terms of how we're supporting you and how we can be better in helping you achieve your goals. So please never hesitate to call us or connect with us regarding that, and we look forward to talking with you soon.